December 15th, 2025. The United States government just crossed a threshold that's only happened 3 times in modern peacetime history. Interest payments on the national debt, $970 billion, now exceed what we spend on the entire Department of Defense. This is fiscal dominance, the point where debt becomes so massive that your central bank can't control inflation anymore. The government's debt servicing becomes the economy, and when fiscal dominance arrives, the 60-40 portfolio collapses. 2022 gave us the preview. Stocks down 19%, bonds down 13%, simultaneously. The retirement planning Bible lost 16.7% in 1 year. This was the reactivation of a historical pattern, a capital reallocation cycle that's played out in 3 major crises across the last century, and it's happening again right now. By the end of this video, you'll understand exactly which 3 asset classes preserve wealth when currencies collapse, why they work, and how the wealthiest investors on Earth are already positioning. Let me show you something that once you see it, you can't unsee it. 3 empires, 3 currency crises, same pattern. Crisis 1. Weimar Germany, 1922-1923. Early 1922, 160 German marks buys you $1. November 1923, less than 2 years later, 4.2 trillion marks buys you $1. The German government printed money at an exponential rate to pay World War I reparations. The mark's value didn't decline, it evaporated. People rushed to bakeries during lunch breaks because by the end of the workday, their wages couldn't buy bread. Banknotes became wallpaper, literally. But here's what matters. The German stock market actually rose in nominal terms during the hyperinflation, and they still went broke. Because commodity prices rose faster than stock prices, the purchasing power of those nominal gains was an illusion. Who survived? Those holding physical gold, those holding foreign currency backed by gold, those holding farmland that produced actual food. Crisis 2. 1970s United States stagflation. Inflation accelerates from 5% to over 25% by 1975. Oil prices quadrupled after the 1973 Arab embargo. Wheat prices tripled. Corn prices nearly tripled. Soybean prices quadrupled. The 60-40 portfolio? Crushed. Bonds lost value as inflation eroded fixed payments. Growth stocks collapsed as rising discount rates destroyed valuations. Who survived? Gold delivered 22.1% real annual returns through the decade. US farmland appreciated 438% in nominal terms from 1970 to 1980. Even accounting for inflation, this represented massive real appreciation. Energy stocks posted average real returns of 12.9% annually. And value stocks, industrial companies with tangible assets and pricing power, outperformed growth stocks by a landslide because they could pass cost increases to customers. Crisis 3. Argentina, 1991-2002. Argentina pegs its peso to the US dollar at 1-to-1 parity. The plan succeeds at first. Inflation dies. Exports surge from $12 billion to $27 billion. Then Brazil devalues its currency in 1999. Argentine exports become uncompetitive. The economy contracts. The government loses access to credit markets. December 2001, bank runs. The government imposes withdrawal limits of 1,000 pesos per month, then forced conversion of dollar accounts to pesos at manipulated rates. $100 billion sitting in Argentine banks converted to 100 billion pesos, which then lost 75% of their value as the peso collapsed. Depositors holding dollar-denominated bank accounts lost 60% of their purchasing power. Who survived? Owners of agricultural land and commodity inventories. As the peso devalued, their peso-denominated assets became cheaper for foreign buyers, driving demand. Global commodity prices surged, making their outputs more valuable. Argentina defaulted on $95 billion, the largest sovereign default in history at that time. Yet agricultural producers experienced massive real wealth preservation. Pattern verified, undeniable. 3 crises, same capital reallocation. Three specific asset classes that consistently preserve and enhance purchasing power while everything else burns. Asset Class 1. Productive land, agricultural assets, commodity exposure. Bill Gates owns 242,000 acres of US farmland across 17 states. He's the nation's largest private farmland owner. Why?
Farmland is a systematic hedge against currency depreciation. When the dollar weakens, US agricultural commodities become more competitive in overseas markets, driving exports and prices higher. The crops the land produces appreciate in nominal terms, but more importantly, they appreciate relative to the devaluing currency. From 1970 to 2019, farmland returns displayed positive correlation with inflation. During the 1970s, farmland's average spread over CPI inflation was 11.1% annually. That means while prices rose 11% due to inflation, farmland appreciated an additional 11% in real terms. True purchasing power preservation. Even in recent decades, 2000 to 2009, farmland's spread over inflation was 7.6%. 2010 to 2019, it was 4.8%. This isn't cyclical, it's structural. The 1970s commodity surge provides the template. The Soviet Union's unexpected massive grain purchases in the early 1970s stimulated world demand. World wheat exports jumped 29% between 1971 and 1972 alone. Production couldn't keep pace. The Peruvian anchovy catch failed in 1972, reducing high-protein feedstocks for livestock and causing soybean prices to explode. And the dollar depreciated nearly 30% by decade's end, after Nixon ended gold convertibility in 1971. Agricultural producers experienced triple appreciation: higher nominal prices, higher real prices, and favorable currency dynamics making exports surge. The same mechanism operates today. The dollar index has declined approximately 10% from its 2022 peak. Government debt exceeds $35 trillion. Farmland isn't a bet, it's a mathematical hedge. Asset Class 2. Gold and non-sovereign monetary assets. Weimar Germany, November 1923. The government printed marks until the nominal quantity expanded from 29 billion to 400 quintillion. The global gold supply? Constrained by physical mining capacity and geological reality. Gold's value in mark terms soared proportionally to the mark's collapse, not because gold became more useful, but because the government couldn't print gold to match the money supply. Gold's value is independent of government policy. When governments debase their currency, gold's relative purchasing power increases automatically. The 1970s confirmed this. Gold rose from $35 per ounce to $455 by decade's end, a 13-fold increase. Today, gold has surged past $4,000 per ounce in 2025, climbing over 20% since mid-August. But here's the signal that matters. Central banks themselves are accumulating gold at the fastest pace in half a century. From 2022 to 2024, net central bank gold purchases more than doubled, surpassing 1,000 tons annually. This surge is driven by Asia, China, India, Japan, and emerging markets broadly. In August 2025 alone, central banks added 19 tons to global reserves. The National Bank of Poland added 67 tons by the end of August, becoming the largest year-to-date purchaser. Why? Reserve diversification. The dollar's share of global foreign exchange reserves has declined from 65% a decade ago to less than 58% today. Central banks are explicitly reducing US Treasury holdings while increasing gold reserves. This isn't speculation, it's institutional recognition that the dollar's role as the sole reserve asset is ending. Physical gold ETF inflows hit record levels in September 2025. Global gold ETFs recorded their largest monthly inflow and strongest quarter on record at $26 billion. Gold doesn't generate cash flows, it produces no dividends. Its value derives from one thing. It's a store of purchasing power independent of government credibility. In an environment where government debt is mathematically unsustainable and central bank independence is questioned, that property becomes priceless. Asset Class 3. Value stocks with tangible assets and pricing power.
Not all equities are created equal in crisis environments. Growth stocks, technology companies with zero current earnings and promises of massive future profits, collapse when inflation rises. Their valuations rest entirely on cash flows occurring far in the future. When discount rates double, the present value of those future earnings gets cut in half. It's mathematics. 2022 demonstrated this brutally. Technology stocks declined 31.5%. Meta platforms plunged 64.2%. But value stocks, companies with tangible assets, near-term cash generation, and pricing power, outperformed dramatically. Value companies generate most of their cash flows now, not in 2030. When inflation rises, they're less negatively affected by higher discount rates.
And crucially, companies with tangible assets and pricing power can pass cost increases to customers, maintaining real profit margins. Energy stocks provide the clearest example. Their revenues are directly tied to energy prices. During high inflation environments, energy stocks beat inflation 74% of the time, delivering average real returns of 12.9% annually. Real estate investment trusts with operational properties and leases allowing rent increases also perform well. Equity REITs outperformed inflation 66% of the time, posting average real returns of 4.7%. When office or industrial leases include provisions for rent increases tied to inflation indices, the REIT's revenues automatically increase as inflation accelerates, protecting real income. From 1928 onward, value stocks have outperformed growth stocks by an average annual rate of 4.5%. During inflationary episodes, this spread widens dramatically. In 1974, during the oil shock peak, value stocks delivered positive returns, while growth stocks collapsed. Today, the same dynamics are re-emerging. Private equity leveraged buyouts with high debt loads face acute vulnerability. With interest rates doubling from pandemic lows, cash interest and taxes consume nearly 100% of EBITDA for many companies. Meanwhile, value stocks with minimal leverage, tangible productive assets, and pricing power in essential goods are positioned to preserve and enhance purchasing power. Here's where we connect history to the present moment. The United States in 2025 exhibits the same characteristics present before every major crisis we've analyzed. Indicator 1. Fiscal dominance threshold crossed. Interest payments on the national debt hit $970 billion in fiscal year 2025. That's nearly triple the $345 billion we paid in 2020. The Congressional Budget Office projects this will climb to $1.8 trillion annually by 2035. $1.8 trillion, approaching twice what we spend on defense just to service existing debt. This is fiscal dominance. When the Fed raises rates to fight inflation, interest payments explode, forcing the government to borrow more, creating a doom loop. Indicator 2. Real interest rates turned positive. For years, inflation ran higher than nominal interest rates, meaning real interest rates were negative. This allowed the government to inflate away debt burdens painlessly. That's over. Real rates are now positive for the first time in years. The government's debt is becoming more expensive to carry rather than cheaper. The favorable dynamics that allowed debt to grow more slowly than the economy have reversed. Without a fiscal surplus, which the US hasn't run since 2001, debt accumulation becomes mathematically exponential. Indicator 3. Central bank independence questioned. The Federal Reserve's balance sheet still holds approximately $4.6 trillion in US Treasuries accumulated during quantitative easing. This massive holding creates the risk that monetary policy becomes captive to fiscal sustainability rather than independent inflation control. This is the institutional signature of fiscal dominance. The central bank can no longer credibly commit to prioritizing price stability because government debt dynamics force accommodation. Indicator 4. Reserve diversification accelerating. Central banks globally are diversifying away from dollar reserves faster than any point since World War II. The dollar's share of reserves has dropped from 65% to 58% in a single decade.
Countries like China, Russia, and Turkey have steadily reduced US Treasury holdings while increasing gold reserves and settling trade in local currencies. This isn't ideology, it's institutional capital allocation by monetary professionals who see what's coming. Indicator 5. 60-40 portfolio breakdown confirmed. The 2022 simultaneous collapse of stocks and bonds wasn't a fluke. It was a regime shift. When inflation becomes the dominant economic variable and government credibility is questioned, the traditional stock-bond correlation inverts. Instead of protecting each other, both decline together. 2022 represented only the fourth time since 1973 that both stocks and bonds experienced negative returns simultaneously over a 12-month period. Now it's the new normal. The math is broken. The 60-40 portfolio cannot function in a fiscal dominance regime. So what happens next? 3 possible scenarios. Scenario 1. Fiscal consolidation. Probability: low. Congress implements credible fiscal reform, combining higher revenues and lower spending. Debt stabilizes. The dollar strengthens. Confidence returns. This is theoretically possible.
It's also politically implausible. Scenario 2. Financial repression. Probability: moderate. The slow drift. Currency depreciates gradually. Real interest rates stay suppressed below growth rates through controlled inflation. Government slowly inflates away debt burdens while eroding purchasing power of savers. This is the soft landing version of fiscal crisis. It's what the British attempted after their 1976 sterling crisis. It's painful, but manageable. In this scenario, the 3 asset classes we've identified still outperform. Farmland appreciates with currency depreciation. Gold maintains purchasing power. Value stocks with tangible assets pass costs to customers. Scenario 3. Acute crisis. Probability: increasing. Confidence in government debt erodes rapidly. A triggering event: geopolitical shock, sovereign rating downgrade, failed treasury auction, causes foreign holders to dump bonds. The dollar depreciates sharply. Inflation accelerates. The Fed faces an impossible choice: raise rates and bankrupt the government, or accommodate and destroy the currency. This is the Weimar path, the Argentine path, the pattern we've documented 3 times in the last century. In this scenario, the capital reallocation becomes a stampede. Traditional portfolios experience catastrophic losses. Only tangible assets, monetary alternatives, and value stocks with real pricing power preserve wealth. The pattern is already emerging. Bill Gates accumulating 242,000 acres of farmland isn't speculation. It's strategic positioning by one of the world's most sophisticated capital allocators. Central banks buying 1,000 tons of gold annually, double the prior accumulation rate, isn't tradition. It's institutional preparation.